It is no secret that technology has shrunken the market for business intermediaries. There are platforms out there that make it incredibly easy for businesses to buy and sell through intermediaries. What that did is that, virtually overnight, shrank the already saturated market of business intermediaries, making your lives much more difficult than they were before. So there are a few options. One is you deal with the competition. Your deal flow is likely shrunk and you fight tooth and nail for every deal that you can get. All the easy deals are quickly pounced upon by the heavily saturated business intermediary market. Option two is you sit back, you wait for the deals that come your way in the happenstance way, or you simply get pushed out of the market. There's another option, which is figure out how to get the hard deals done. Figure out how to complete the deals that everybody else turns away. Now, consider this. The market is shrunk and saturated by the technology and the platforms already. Now, we are already in a record growth economy. We have been growing at a rate that surpassed any growth period in any time in this country's history. For those that are economists out there, you will know that markets go up and down. So when you couple the saturation of the market with the technology and the fact that inevitably we are going to experience an economic downturn that is only going to tighten up this world and this deal flow even more. So the bottom line is, I don't think that business intermediaries have a choice. I believe that there is only one decision that needs to be made. Figure out how to conduct the hard sales, the hard deals, or get pushed out of the market. Now, Adam Duso, our CEO, is going to talk a little bit about what a hard deal is and what we do as a tool for you.
So what do we mean by what is a bad deal? Simply put, a bad deal is any one that an intermediary or business broker comes across that they don't feel that they can bring to a successful conclusion. And I can break that down into a variety of different categories, which I have listed here, that are the most common reasons for rejecting a deal and not bringing it to a listing and eventually a closing. The first is that the business broker or intermediary does a market valuation of the business, and that valuation is less than the debt owed by the business, which removes the incentive for the business owner to proceed with selling their business at that given time. In other words, the business based on valuation is a short sale. Another item is that the cash flow of the business has somehow been reduced, whether that's through market conditions, additional competition, or other areas, and therefore cannot support its current expenses, including debt service. In other words, it's a distressed business experiencing distressed cash flow. And the last is that the asset value of the business for which the debt was based off of is also less than the outstanding debt, meaning that the business is upside down on its asset value, again, indicating a short sale. So what our process is, which I'm going to get into in the following slides, is a solution. And what we are looking to do is create a partnership that will allow business brokers to value incoming businesses based on their top line revenue and their gross margins, and be able to understand that our business can turn around those businesses in a matter of weeks as a saleable commodity, regardless of how complex their balance sheet once was and how much debt was once on it. One of the ways that we do this, which I'm going to go into now, there are several different versions, but the most common that we use and the one that will bring you the most value to know about first is the Article 9 UCC sale. I would imagine that most people on this webinar are familiar with the Uniform Commercial Code and UCCs. You've almost certainly been exposed to them as part of one or more of the closings you've done in the past. But just to cover all the bases, the Uniform Commercial Code is a code that's adapted nationwide that regulates the flow of goods and services between businesses. Secured creditors file UCC-1s to secure their interest in business collateral. And that's where you would have come across that preparing for a closing, making sure all the UCCs have been satisfied or terminated. Part of the Uniform Commercial Code is what's known as Article 9. And what that does is it provides a provision for the first position UCC holder to sell assets of the business free and clear of the other UCCs on it, so that they have a vehicle to sell their collateral and pay down their outstanding obligations without the expensive need for a foreclosure and auction. So what this does is it allows short sales to be done in a manner that require only the consent of the first position UCC holder, rather than the traditional method of trying to have negotiations with each and every class of creditor prior to the closing of any transaction. This article and all of its terms and conditions are what allow us to take a business that is over leveraged with multiple secured lenders and strip off those UCCs and turn the business around to be resold in a matter of weeks. One of the conditions that is required under this is a 10-day notice to all of the subordinate UCC holders, which gives them a period of time to respond and foreclose up and become the first position creditor should they choose. So the results of this type of sale in our eyes is what we call the win-win, win-win-win. So we're going to walk through that in a slide here to describe how this actually benefits all parties involved in this type of transaction. The first win is the first position creditor. It's pretty obvious that they're able to sell their collateral for a maximum value, and they're actually able to close that transaction because they're able to deliver the assets free and clear. If they didn't have this vehicle and the other subordinate liens stayed attached to the assets of the business, there would not be any interested buyers on the market because no one would want to assume the debt. So what this does is gives the vehicle to the first position creditor to sell successfully for a maximum value on those assets. The second win is the seller. The seller was looking to create a successful exit. Due to their debt, they were of the belief that that was impossible. What this does was allow them to actually get to a successful short sale closing and exit the business. It also preserves an opportunity now that there is a buying pool for this distressed business where they may be able to earn from the transaction or continue to work and operate with the acquiring company, depending on who that individual is. The third win is the buyer. So buyers that identified a strategic acquisition that otherwise would have passed on the opportunity due to the outstanding debt now have a vehicle in which they got to a successful closing, bought the business that they wanted, and did so in a manner that didn't have them have to pay off all the existing debt. The fourth win are the subordinate creditors. While they may or may not be getting anything out of the sale of the assets, the debts owed to them from this distressed business were essentially toxic assets. So by having this come to a quick fruition, which didn't require litigation, collection, or other costs, they're able to wind up this matter, write off the toxic assets on their balance sheets, take the credit or the tax credit from that, and if that subordinate creditor is a vendor, have the opportunity to preserve the ongoing business relationship with the purchasing entity, whereas they were headed towards losing not only the debt that was owed to them, but the ongoing business relationship if the business had been left to its own and failed. And then the last win is a broker, the broker who was able to close a deal and bring it to closing that it would have otherwise just discarded as a short sale that was too complicated and unlikely to close.
Forgive me for interrupting, Adam, but I actually think that there's a sixth entity that wins here, and that is the business itself. Through this Article 9 process, we are able to preserve the value of the operation. Therefore, instead of destroying the business, which would otherwise occur in a bankruptcy or a creditor liquidation, the business itself wins. The business operation wins because it is able to live on and fight another day.
Good point, Aaron. I think I just ran out of room on this slide. So let's call it 6 wins all around. And I'm sorry, I'm missing a circle here. So what I'd like to do is go into an example. This is, if you're like me, numbers behind something like this make a lot more sense. So here's an example of a fictitious character that we're going to run through a similar deal, and so that everyone can conceptualize how something like this would work. So let's say a business broker runs across somebody named Larry Lancaster who owns a manufacturing company in Ohio. As the business comes in and Larry is considering exiting his business, the broker does a valuation and comes up with a market valuation of the business of $3 million. Based on the balance sheet and the estimate of the value of the hard assets, there is a $2 million asset valuation. And also by reviewing the balance sheet and confirming its accuracy, you find that there is $5 million worth of total debt outstanding. So typically this would be discarded as a potential opportunity, because even if you're successful, you're only going to sell the business for $3 million, and yet there is $5 million worth of outstanding debt. The debt portfolio breaks down in this fictitious scenario as $2.5 million as an SBA loan owed to a first position SBA lender, and then $2.5 million of other subordinate debts, whether they're term loans, lines of credit, trade debt, whatever it may be. Using this fact pattern, someone teaming with Second Win could pass Larry and his company over to us, and what we can do is identify a buyer who would be willing to purchase the business assets for their asset valuation of $2 million and offer Larry Lancaster a $1 million earnout based on performance. What this does is it gives the first position SBA lender a very reasonable return on its collateral, which is the assets of the business, and incentivize them to conduct the Article 9 sale, wiping out any subordinate debt on the business and allowing the transaction to get to a closing. The SBA bank then followed procedure and it gets its SBA guarantee. For those of you who do a lot of deals with SBA lending, you know how important that can be. And due to the fact that Larry has a potential to earn and doesn't himself end up in a personal bankruptcy, they're actually going to get compensated through what's known as the offer and compromise, or the settlement of any personal guarantees. So the buyer, again, wins because they're able to come in at an entry price that's below market value, and their downside risk is protected. However, they pay a valuation of equal to market value so long as Larry performs and hits key performance benchmarks, which shores up their ROI when they initially wanted to go into this transaction. So that more or less sums up a potential or simple Article 9 sale, if there is ever such. And now I want to go into qualifications. As we describe this to brokers and intermediaries all over the country, we often get feedback as to how this could be used and abused solely to avoid paying creditors. And so part of the qualifications of an Article 9 are what stop this from happening. So the requirement under an Article 9 sale is that the assets being sold need to be sold for adequate consideration. In other words, they need to be based on a third-party opinion of value. So if a borrowing business or the businesses that want to be conducted under this Article 9 sale have to meet a few criteria. The first is that they don't have the asset base or income to support full repayment. So if you have the asset base or income, or if the business has the asset base or income to support a full repayment of the outstanding debt, then adequate consideration, as it's defined, would require a payment of the full amount of the outstanding debt, which would therefore negate the need for an Article 9 to begin with, because all of the outstanding debts would be paid off. So this is actually a self-regulating process, because Article 9 can be challenged on adequate consideration. So those who have the means to pay their debts and are looking to use this system to avoid it, the end result of a properly conducted Article 9 sale would be that those people end up paying off their creditors anyway, which would, again, negate the need to even conduct the Article 9 sale. However, if you meet that requirement, you do, as I state before, need to send 10-day notice out to the subordinate UCC holders. And what that does is give them 10 days to challenge the sale for adequate consideration, or, as I stated before, elect to foreclose up in order to take over the first position. So because these are done as short sales, no one ever elects to do the latter, which is foreclose up to then not get paid off in full. And because if these are done properly, the asset valuation is based on appraisal, that also removes the likelihood of challenge for adequate consideration. So in our experience, when these are conducted properly, there is almost no response at all inside of that 10-day period. At the end of that 10-day period, the assets are allowed to be transferred free and clear. So all outstanding UCCs are terminated, and the assets are transferred from the seller to the buyer free and clear of any liens or encumbrances.
So it's clear to us that there is a very glaring problem in the country, in the economy. This pay-or-fail dichotomy is destroying businesses that could otherwise be preserved, that otherwise could succeed, and with that, the jobs, the families, and the operations dependent upon its success. It's clear to us that there is a problem in the intermediary industry based on the growth of technology and the presence of platforms that are oversaturating the markets and making the easy deals extremely hard to come by, and making it very difficult to complete deals in general. The question is, what are you going to do about it? At Second Wind, we strive every single day to preserve those businesses, and we strive every day to change the way debt is viewed in this country. And together, I think that we can make a real difference. So that's what we have for you today, and we hope that you have found it interesting and educational, and we are greatly looking forward to implementing our Article 9 strategies to your benefit and to help you expand your deal flow and allow you to be the business intermediaries that can get the deals done that nobody else can.